Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I wanted to talk about the Swiss franc. Switzerland is a popular travel destination and has sometimes been known for being an expensive one. Many years ago, I recall on one of my own early trips of expressing just a little bit of shock the price of a hot dog on the shores of Lake Zurich, which wasn't helped of course by the strength of the currency itself. Now today, like many other economies, inflation in Switzerland is running above its central bank's preferred range. The May CPI inflation number came in at 2.9%, and while this may seem relatively tame compared to what many other economies are facing at this time, the number was the highest in about 14 years and exceeded the Swiss National Bank's mandate of capping inflation at 2%. Now, this was not the first time either, with headline inflation exceeding this cap since February. Now, we know now that the SNB did follow up with a 50 basis point rate hike a few days ago. This was a notable rate hike, both because it caught markets by surprise. Most forecasters did expect no change, but it was also the first rate hike since September 2007, about 15 years. Now, Swiss National Bank Chairman Jordan said rising inflation meant further rate hikes were likely in the pipeline, and markets are now expecting further rate hikes at each of its upcoming quarterly policy meetings. Now, for the dollar CHF currency pair, this meant a sharp move lower, briefly interrupting what was a clear uptrend. However, we are of the view that the dollar CHF pair could start to rise again, with this rate hike-led pullback representing an attractive opportunity to go long on the currency pair. Currencies are ultimately relative, and while the SNB may be hiking rates itself, the pace of rate hikes is likely to lag those of the Fed considerably, which is expected to hike rates by 75 basis points, therefore putting it on a much steeper rate hiking path. The Swiss franc is not immune to broad US dollar strength either, and while we do expect the US dollar to peak and turn lower over a 6 to 12 month horizon, it is possible that we continue to see a well-supported US dollar over a shorter time horizon. Now, this baseline bullish view on the dollar CHF pair notwithstanding, we would watch three signposts as signals for where the currency pair might go from here. Now, first would be the nature of any incoming messaging from the Swiss National Bank itself. While the central bank is scheduled to meet quarterly, it did announce it would hold a press conference after each policy meeting from now on. These will be key, of course, to gauging whether the central bank is likely to stay on a rate hiking path over the next few quarters, as markets now expect, or if a pause at any point is likely. Now, second, of course, we'd remind ourselves that currencies are relative. So what the US dollar does and what Fed Chair Powell says at his upcoming testimony to Congress this week is also key for the dollar CHF currency pair. Now, while it's much more likely that hawkish messaging from the Fed, a lot of that came through last week itself, as the Fed delivered both a 75 basis point rate hike and said its commitment to combating inflation was, quote, unconditional. A continuation of a relatively hawkish message at this week's testimonies to Congress could keep the dollar well supported, which of course is consistent with our own view for dollar CHF to drift higher. Finally, of course, we'd keep a close watch on technicals. From a bigger picture perspective, dollar CHF does face resistance at 1 versus the US dollar, which is around the peaks of recent jumps, while on the downside it does face support around May lows at 95.4 cents. Now, overcoming more minor resistance levels at 97.9 and 98.9 cents would bring greater confidence that the currency pair is back in an uptrend. However, we do believe it would be prudent to be disciplined about keeping 95.4 cents support as a stop loss on our view, because a break of that level could signal that the uptrend is pausing or even potentially reversing. So, few key levels to watch, but we do expect the dollar CHF pair to continue to trend higher. But we'll pause here. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening. Wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.